Hey guys, welcome back to my channel. So today we're just going to be going over a little bit of continuation of how to get funded with your startup to a VC. But also this is going to be more of the VC math part once you've kind of made it to the communication and kind of breaking in and what they look for within a startup founder and founding team. So we're going to be going over the process of due diligence, right? And I won't go too far into this, like what your deck should look like, data room, and other things, because that's a whole nother episode. But what I will go over is things like key metrics and best practices. So guys, rules of the game here, right? Due diligence is when they're screening your startup for potential investment, and they're going to be looking at all sorts of things. Most importantly, they want to know what you're talking about, the plan ahead, and most importantly, how they can also generate returns to their fund, because according to this fund structure, they also owe money back to their investors after a certain period of time, and exit multiples and all that other stuff we can get into later. But let's just set some ground rules here before you go over metrics, right? Transparency is key. So during due diligence, be transparent about your financials. Hiding or manipulating information is an easy way to get barred, not only from the investment firm, but from the industry period, because they all tend to talk to each other. Next is know your numbers. Know the ins and outs of the financial metrics and be prepared to explain assumptions in detail, because a lot of this stuff is forecasting into the future, but you have to know at least that you're on a good glide path. And lastly, address your weaknesses head on, right? If there's something that you feel like is going to impact your numbers and other things like that, say it now rather than later, because also this could be a potential partnership too that they can help solve with their in-house expertise. Okay, I'm not going to tell you every metric underneath the sun, but there's a few that you need to be aware of when talking to an investor. So let's start with burn rate, right? So this is the rate that a company is burning cash. And you need to be aware of this number and however it manipulates, because they're going to gauge it on how well you could use the funds in the future based on what your burn rate is right now. This next part leads into what's called runway, right? And this is closely tied to the burn rate that I just mentioned, because it's the amount of time that a company has quantified in months before it runs out of cash. The longer runway is generally better, and I'm going to keep this example on the screen for a little bit. You can pause the video. I just don't want to kind of like explain this too much, because it should be relatively self-explanatory. But longer runway is better, and that is one of the most surefire metrics for early stage companies, because a lot of the financials aren't set in stone yet. And lastly, LTV to CAC, right? Lifetime value over customer acquisition cost. This one has always been a really solid one, and I just kind of want to dive into this as well. So lifetime value is the predicted net profit that a customer is going to go throughout the lifetime of just using the product over the customer acquisition cost. That is the cost to acquire this. Right now, a high LTV to CAC is a good signal for investors. This is for longer has always been one of the largest and most reliable KPIs, key performance indicators, that people use. Now, there's a few things that could help on the financial side, right? And this is revenue projections. So as you see on the screen here, revenue is used in a lot of the major valuation techniques that's going to value your company. As you can see, having good projected revenue or revenue is going to be important, because having a realistic revenue projection, investors want to see that you have a clear and well thought out plan on how you will generate revenue over time, especially when you take on this new funding. Next is going to be, you're going to hear the word unit economics a lot, right? And this breaks down to the revenues and costs associated with each product or service. And it's essential for understanding your overall revenue model for the business. And then lastly, it's going to be your gross model. And that represents the percentage of revenue that exceeds the cost of goods sold. And a healthy gross margin is a really good positive sign for investors. So guys, I know that was a lot, right? That was kind of like the 30-foot view, but I just gave you a crash course in VC math. That wasn't everything, but it's some of the most important things, guys. And I will see you on the next episode.